Okay, so in this world of finding money, finding investors, we've got a story to tell. You prepared. You got all your material for due diligence. All that's kind of ready. You may have to tailor it a little bit depending on who you go after, but the next thing to figure out, and perhaps you've already thought about it, is who the heck are we going to approach? I want you to keep something in mind. I am not recommending that you go approach anyone unless you have to. I'm recommending you fly under your own steam. If you want to start a business, save up some money, get your family involved and supportive and all that, and fund it yourself. Put your own finances at risk. But there are a lot of cases where you're going to need some outside money, particularly if you're developing something or there's a lot of capital equipment involved. That's okay. I understand. So we're going to spend the time now to talk about that case where you got to go get money from someone else. I think I've pretty well covered what you got to do next if you're funding it yourself. You're convinced. Now you're going to spend the money on a plane you've already developed. That's pretty smart. But let's move on into this. So, who to go after? Chances are you've got a pretty good idea of how much money you need. You should, from your financial forecast, and the form of investment you want to take. And I'm hoping it's predominantly a loan. Getting into the equity world is a whole other game, which we'll cover in a minute. But you want to do kind of a search through all of the possibilities of finding the kind of money that you want and from whom you want it. This is called get on Google, do some searches for the kind of investing organizations that might be the right ones for you, or the right banks or forms of banks that you should be approaching. Or if you're considering going the friends and family route, who are the family members or my business associates more likely, and friends that you know well and know you and trust you, who are they? We're going to get down to the nuts and bolts of naming either the people or the institutions we're going to go after. So you're going to do a search. So this is like market research. In the case of investor organizations, you go to their websites, you read their criteria, you read their mission, and you check out, well, what the heck are they invested in themselves? And if they're pretty much in the kinds of industries that you're in, that might be a good candidate. But you check it out. So you find equity investors that way. Searching for the right banking institution is important for you to do. I'm urging you to stay away from the big national banks. They have little leverage to make judgments about giving people loans for businesses, especially startups. You should consider regional banks, have a little bit more flexibility in providing loans to people who are credit worthy. You have to be credit worthy if you're going to go to any financing institution. Good credit score, way above 650. You have no judgments against you. If you know about the financing institutions, which again you'll find on the internet, and see what financing instruments they have available. And you'll wind up approaching them and learning more about it and filling out an application. But we'll get into the details of that in a minute. But you're going to search for the kinds of institutions, friends and family and business associates, financing institutions for loans, equity investor, which are angel organizations or private equity. But do the research to find the right money for you and create a strategy of exactly which ones you're going to go after. The next is, once you've selected a handful, by the way, this is not 20 or 30, you need to be very selective about this. You're not going to waste your time, worse yet, waste their time on approaching financing sources that just aren't right for you. You know it from the beginning. So when you prepared for this, you figured that out. You're going after the right ones. The way to approach them is upfront and personal. No emails. It's a phone call at the least, a brief one, to simply ask for a discussion. You're not going to present your case without some personal interaction with them. I would think that you're going to approach the people you know first. The people could be private individuals, it could be investment organizations, it could be banking institutions. The ones that know you already are your best bet. Out of that list of prospects you went through when you did your search, pick the ones that you got the best shot at because they already know you. So the way you're going to approach any of these people is a telephone call, no emails, nothing impersonal. A phone call, it sets up an opportunity for you to have a sit-down meeting. Now, in today's world, that could be over Zoom, or it could be a properly socially distanced direct meeting. But you want to get face-to-face with them as best you can. And talk to them about a business opportunity you have. That's all you've got to say to them in this initial contact. I've got an opportunity I'd like you to listen to, and I want to see what you think about it. Something rather general. You're not going to start negotiating the financing of your company over this first phone call. Approach this in a very professional way, even though some of these people may be close associates of yours, friends of yours. Do every single one of them, the banks, the equity investment organizations, the crowdfunding organizations, do each one of them in a very professional way. Treat them equally as important. Don't assume anything about any one of them. You just want a first meeting with them. So that's the initial approach on these kinds of people. You want to have an initial discussion with them. So now let's take each one of the kinds of financing sources and let's talk about what happens after you've made your approach. So associates, what I mean by this is the old adage of friends and families and fools. So it's probably mainly business associates and friends. People you know, they know you. It'll be easy to get a meeting. But when you approach them, you treat them just like any valued business partner you'll ever have. You give them a professional presentation that you have prepared, just like you would with a bank or with an equity investor organization. The very same treatment. You give them a full pitch, assessment of risks, how much money you're raising, what you're going to use the money for, and the deal you want to make them. Chances are, for associates, you are going to ask for a loan. I don't suggest you ask for friends to make an equity investment in your company and risk their money. Quite frankly, if you're going after equity, which we'll cover later, you should be only doing that with accredited investors. More later on that. So, but these are the friends and family kind of crowd. A loan at a handsome interest rate because they are taking a risk, and your commitment to pay it back no matter what happens. Yes, you're going to guarantee this loan to your business associate. They're not risking anything. You will pay it back. It may take you a long time, and they're going to understand it. That's part of the risk they're taking, but you're committing to pay it back. That's the best approach with these kinds of people, because you want to keep them as friends. If your company fails, you're going to keep your promise to pay them back. So that's associates. Banks, some of you are probably wondering, why the heck am I even suggesting banks? Well, let me tell you why. Because some banks do this. If you're a person with great credit, you've got a personal balance sheet that looks attractive, when the bank asks for your financial status, it's going to look pretty good. You have no judgments against you. And you probably will personally guarantee all of what you're going to be borrowing. The kind of banks that would consider this are not the nationally known, multi-hundred-billion-dollar banks. It's the more regional banks, ones in your area and a few cities around, ones that are the salt of the earth. They establish relationships with the community in which they reside. They are regulated to a certain extent. Many of them are under the umbrella of the strict regulations that you're hearing about today, passed by Congress many years ago, and are able to make judgments in their underwriting that could enable them to take the risk in loaning you money. But quite frankly, they're not going to do it unless they know you can pay it back. I mean, that's a rule of the game no matter what bank you go to. Now, there are other kinds of banks, they're called community development banks, abbreviation CDFIs, that also provide business loans. They're much more liberal, they're not regulated, and providing bank loans to people who are part of the underserved community. So they could not otherwise get money from banks. Now, the ones I know of also have pretty strict guidelines for underwriting as well, but they can make much more attractive judgments about loaning you money. We're only talking maybe a few $100,000 tops in these kinds of institutions, but if you got, just Google on CDFI and a bunch of, and probably you'll get a site that lists all the CDFIs in your state. So those are banks. Now with equity, we're getting into a little bit harder financing. Harder in that there's a lot you have to do. When you approach them and get them interested in your business, you have that telephone call, perhaps the person who leads an equity organization or a small private group, the leader of it, or a private individual for that matter that does equity financing. No matter what it is, the first thing you got to do is get a meeting with them. So you do that telephone call I mentioned earlier, but you're going to go give them the full presentation, and they're going to take you then through, if they like what you're doing, that is, they're going to take you through a due diligence process of some kind where they really check out what your business is all about. And in the more sophisticated equity organizations, the angel groups, and every state is full of them, there's hundreds of them around the United States, the organization goes through this due diligence process, they vote to make an equity investment, and you are selling a part of your company. The amount of equity you sell in your company, the percentage of your company, the stock in your company that you're selling, is greatly determined by what the value of your company is, which is a negotiated item that you have with them. You think your company is worth this today, and they think it's that, and you somehow meet in the middle. That's a reasonably structured conversation, and a lot of nuance and a lot of know-how as to what the market will bear these days for startup companies. So equity financing is a process. It could take you 3-4 months to close an equity deal with most angel groups. If you do it with a private individual, it could be a lot faster. But you're going to get the money. You're going to have to explain all the same things and how you're going to use the money. And they're going to want to take a board seat, things like that, in order to keep track of what you're doing. And on the positive side, going to try to help. It's in their vested interest to open up their address book, if you will, to help you in any way they can to be successful. That's in their best interest. Hardly any of them are going to take a position in your company, marketing, sales, development, or anything like that. They're going to be passive investors, but they're going to want to know how you're doing every month or two. So that's equity investing. Crowdfunding is another source of financing that you can go after. It is just as hard as any one of these alternatives I took you for. There's no panacea about this. It's a lot of work. It's a lot of money to actually run one successfully. But you can do a donation-based campaign. If you've got a reward of some kind you can give in return for several $100 or $1,000 or $2 of a donation that they make towards your business, and you give them some form of consideration and maybe a free use of a product you're developing, whatever it is. There's equity-based and loan-based crowdfunding as well. For loans and or equity, criteria for being successful is about the same. You're raising money from a crowd of people, hardly any of them you know, or you're raising money from equity investors who you don't know either, whichever it is. So you've got to have a dynamite campaign. The approach in this is you put up a great website, a special place that these people can go to find out all about your business. They could read your business plan. They could see your presentation, maybe a video of you doing it. They can see that people are already investing. That means you've already seeded this campaign with 20% of the total amount you need, so people can see, there are a lot of people interested in this. Maybe I should be too. And you've got to have one hellaciously smart, well-run marketing campaign. And if you don't know how to do one, you're going to have to contract with somebody, and that could be many thousands of dollars. If you're in an equity situation, you ought to be thinking that this is going to cost you $20,000 to $30,000 to do. Big hunk of it's marketing, the rest is lawyer fees. If it's a loan, it'll be a whole lot less, and you can do other interesting ways to pay it back through a revenue share kind of approach to paying a loan back. So kind of this pay as you go, and as you have the money kind of approach is getting popular today. But crowdfunding is, you're distant from the people that are actually investing in your company, but you're influencing them through a great outbound marketing campaign that brings them to your site, convinces them to invest, and they do. And you give them the kind of return you promised, of course. That's part of the deal. So that's crowdfunding. As you can tell by my tone, I'm not strongly encouraging you to go off and do this one. It's a lot of work. And you got to know what you're doing, or you're going to waste your time and waste your money doing it. Grants, the final one. Grants are kind of special, kind of fall into two forms. The government grants, and I'm thinking of the SBIR program from the U.S. government, or the STTR program, very similar program, where government agencies are looking for technology innovation, whether it's in the biotech field or information technology fields, for people to solve certain problems. And there's a very formal process by which you apply for these grants. Applying for these grants takes some really special talent and know-how. If you've never done one of these government grants, you should get a specialist to help you do it. And there are plenty around. But people know how to write these grants. It's kind of an art form. I hate to demean it in any way, but you've got to be rather precise in the way you communicate so that you meet, by the way you've written your grant, all of the requirements that they're asking for. It's competitive, many people will apply, and you've got to win. You can get many hundreds of thousands of dollars, and by the time you get to the second phase of this grant process, you can be well into $1 million or more. So this is great money. It takes a lot of work, and you're going to be faced with a lot of reporting during the course of using the money, but you don't have to pay it back. It's not a loan, and it's not an equity investment in your company. It's a grant. You get the money, you got to report, and you got to get the results they're expecting. What they want for the money is something really done, and something that's going to be really commercialized. So keep that in mind. This is not like a science project that they're funding. They want results. Foundation grants are also possible. These are mainly for the nonprofit world, where throughout your state, you got foundations from corporations that are funded by pension funds, that are funded by companies themselves, funded by private individuals that are very, very wealthy, providing grants to people for social causes of all kinds. You can easily find these. Again, let Google be your friend. I predict you'll come up with a list of 30 or 40 of them without breathing hard. What you do then is go to every one of the websites one by one and see what their criteria is and what it takes to apply and whether you even qualify for what they're asking for. So do all that research. Find 4 or 5 that may be a fit for you. Go for it. So that's foundation grants. So in all of this, whatever you're doing, you're looking for smart money. What do I mean by smart money? Money is money. What's smart about it? Well, the people who have it are the smart ones. And those people that are going to loan or take equity in your company bring more value than just the money. You need the money, no doubt about it. But you need a relationship. An investor or someone who loans you the money to be a partner in a sense, although you're not signing some form of partnership agreement, but they're going to be supportive of what you're trying to do. They're going to help in certain ways, perhaps introduction to people from their address book that could help you, or could be possible partners, or could be further investors. They're active in helping you be successful. investors that are just throwing money at you and there's no more value than that, you probably ought to move on to another one. So get smart money and have a good day.